Peloton did not weaken because people stopped exercising. It weakened because demand created during a global disruption was treated as permanent. During the pandemic, home fitness equipment surged in popularity. Gyms closed across major markets as lockdowns restricted movement and public gatherings. Consumers stayed home and searched for ways to maintain exercise routines indoors. Peloton's connected bikes and subscription platform quickly became a cultural phenomenon. Revenue expanded rapidly as new users joined the platform at unprecedented speed. Production scaled aggressively to meet the surge in orders. Marketing intensified as the company sought to dominate the home fitness category. At its peak, Peloton's market valuation exceeded $40 billion. But the demand surge created by the pandemic was temporary. When consumer behavior normalized, the expansion built during that surge became the source of the company's collapse. Peloton was founded on a simple but ambitious idea. Traditional home exercise equipment had long struggled with engagement. Most stationary bikes eventually became unused household objects. Peloton attempted to solve this problem through connectivity. The company combined hardware, software, and live fitness instruction into a single platform. Its flagship product was a premium stationary bike equipped with a touchscreen. The screen connected users to a digital library of instructor-led fitness classes. These classes were streamed directly into the home environment. Users could participate in live sessions or access a large catalog of recorded workouts. Performance metrics were displayed in real time on the screen. Riders could track cadence, resistance, and output during each session. The platform also included competitive leaderboards. This created a sense of community and competition among users. Participants could compare their performance with thousands of other riders. The model combined physical hardware with recurring digital subscriptions. Customers purchased the bike as an upfront hardware investment. They then paid a monthly fee to access Peloton's class platform. This structure resembled the economics of a technology platform. Hardware created the installed base of users. Subscriptions generated ongoing recurring revenue. Investors saw this as a powerful hybrid business model. It combined consumer electronics with digital services. Recurring subscriptions also created predictable long-term revenue streams. Peloton positioned itself as a premium fitness brand. The product emphasized design, quality, and high-end experience. Classes were filmed in professional studios with charismatic instructors. The company invested heavily in production quality. Instructors became recognizable personalities within the platform. This transformed the experience from simple exercise into digital fitness entertainment. Users often developed strong loyalty to specific instructors. The platform therefore created emotional engagement with the brand. Peloton also built strong network effects around its community. As the user base expanded, the competitive leaderboards became more active. Live classes attracted larger audiences. The sense of participating in a global fitness community strengthened. Investors believed this model could redefine home exercise. The company appeared to combine technology platform economics with lifestyle branding. This vision positioned Peloton as more than a traditional equipment manufacturer. It was presented as a technology-driven fitness ecosystem. Before the pandemic, this concept was already attracting strong investor interest. Peloton's challenge was no longer proving the concept. The challenge would become managing the scale of its success. Peloton's early growth was driven as much by branding as by technology. The company positioned its product as a premium lifestyle experience. Its bikes were significantly more expensive than traditional stationary bikes, but Peloton did not market the product as simple exercise equipment. It marketed the experience of belonging to a fitness community. The brand emphasized motivation, performance, and personal transformation. Advertising campaigns highlighted the immersive nature of the platform. consumers were shown participating in live classes inside their homes. Large touchscreen displays and studio-quality instruction differentiated the product. The instructors themselves became central to the brand identity. Many developed strong personal followings among subscribers. Users often returned to the same instructors repeatedly. This strengthened emotional loyalty to the platform. Peloton also built an online social ecosystem around its users. Riders could follow friends and compete on performance leaderboards. Shared milestones and performance achievements were displayed publicly. This transformed individual exercise into a social activity. The company invested heavily in high-quality production studios. Classes were filmed with professional lighting, sound design, and camera work. The visual presentation resembled broadcast-quality fitness programming. This production quality reinforced Peloton's premium positioning. The company expanded its subscription content library rapidly. New classes were released daily across different workout categories. Cycling remained the central product, but additional fitness classes were introduced. Strength training, yoga, and stretching programs broadened the offering. This expanded the platform beyond a single hardware product. Subscribers increasingly viewed Peloton as a full digital fitness service. Revenue growth accelerated as more users joined the ecosystem. Hardware sales created a growing installed base of connected devices. Each new device increased the pool of potential subscription revenue. Investors paid close attention to subscription retention rates. Peloton reported strong engagement from its user base. Many subscribers exercised multiple times per week on the platform. High engagement translated into relatively stable subscription revenue. This combination of hardware sales and recurring subscriptions attracted investor confidence. The company appeared to have built a powerful brand in the fitness market. By the end of the 2010s, Peloton was no longer a niche startup. It had become a recognizable consumer brand with global ambitions. The company's challenge would soon become managing demand that exceeded expectations. In early 2020, global events dramatically altered consumer behavior. The COVID-19 pandemic triggered widespread lockdowns across many countries. Public spaces closed as governments attempted to slow virus transmission. Gyms and fitness studios were among the first facilities forced to shut down. Millions of people suddenly lost access to their normal exercise routines. Consumers began searching for alternatives they could use inside their homes. Demand for home fitness equipment increased rapidly across the industry. Peloton was uniquely positioned to benefit from this shift. Its connected bikes already combined exercise equipment with digital instruction. The platform allowed users to participate in guided workouts without leaving home. As lockdowns spread, Peloton's product became increasingly relevant. Orders for the company's bikes and treadmills surged. The number of new subscribers also expanded rapidly. Peloton's digital fitness platform began attracting unprecedented user traffic. Live classes regularly filled with thousands of participants. The company reported record sales growth during the early pandemic period. Revenue expanded far faster than analysts had previously expected. Consumer demand quickly exceeded Peloton's existing production capacity. Delivery times for new bikes began extending into several weeks. Customers were willing to wait because alternative fitness options were limited. The company's product became associated with pandemic-era home routines. Social media further amplified Peloton's visibility. Users frequently shared workout achievements and progress online. The brand gained significant cultural presence during this period. Peloton instructors also became widely recognized public figures. Media coverage highlighted the company as a pandemic success story. Financial markets reacted strongly to these developments. Investors interpreted the surge in demand as a major growth opportunity. Peloton's business appeared aligned with long-term lifestyle changes. Some analysts suggested that home fitness would permanently replace gym memberships. The company's management faced an important strategic decision. They needed to determine whether the demand surge was temporary or structural. The scale of incoming orders suggested a large and expanding market. Management began planning for significant production expansion. Manufacturing output would need to increase dramatically to meet demand. Logistics networks would also need to scale rapidly. These decisions would later become central to Peloton's financial trajectory. At the time, however, the surge appeared to confirm the company's long-term vision. The home fitness market seemed to be expanding at extraordinary speed. Peloton's platform was positioned at the center of this transformation. The surge in demand forced Peloton to confront a major operational challenge. Its existing production capacity had been designed for steady growth. The pandemic created a sudden expansion in global orders. Delivery delays became increasingly visible to customers. In some regions, waiting times extended for several months. Management concluded that production capacity had to increase rapidly. Peloton began expanding its manufacturing and logistics infrastructure. The company invested heavily in new production facilities. Supply contracts were signed to secure long-term component availability. Manufacturing partners were asked to increase output significantly. These commitments were based on expectations of sustained demand growth. Peloton also expanded its internal logistics operations. Warehousing capacity was increased to handle rising inventory flows. Distribution networks were redesigned to deliver large fitness equipment more efficiently. The company also increased its employee headcount. Thousands of new workers were hired across production, logistics, and customer service. Peloton attempted to vertically integrate parts of its supply chain. In 2021, the company announced plans to build a large manufacturing facility in Ohio. The factory was intended to reduce reliance on external manufacturing partners. It would also shorten delivery times within the United States. At the time, the investment appeared justified by demand conditions. Customer orders continued to arrive at extremely high volumes. Financial forecasts assumed that demand would remain elevated. Peloton's management began planning production capacity based on these forecasts. Marketing campaigns also expanded during this period. The company attempted to capture as much market share as possible. The company's leadership believed it was defining a new category of connected fitness. Scaling production was seen as necessary to dominate the market. However, production expansion requires long-term commitments. Manufacturing facilities cannot easily be scaled down once built. Supply contracts often lock companies into fixed purchasing volumes. Hiring decisions also increase ongoing operating costs. These structural commitments would later create financial pressure. The expansion strategy assumed that pandemic-level demand would continue. This assumption would prove increasingly uncertain as global conditions changed. Financial markets responded enthusiastically to Peloton's rapid growth. Revenue expansion during the pandemic exceeded most investor expectations. Quarterly sales reports showed dramatic increases in hardware demand. Subscription numbers also rose sharply as new users joined the platform. Investors interpreted these figures as evidence of long-term structural growth. Peloton's business model appeared to combine hardware sales with recurring digital revenue. This combination resembled the economics of successful technology platforms. Market analysts began projecting sustained expansion in the connected fitness category. Valuation models incorporated assumptions of continued high growth rates. As a result, Peloton's market capitalization increased dramatically. The company's share price climbed steadily throughout 2020. Investor optimism reflected the belief that consumer habits had permanently shifted. Working from home had become widespread during the pandemic. Many observers believed home fitness would follow the same pattern. Peloton, therefore, appeared positioned at the center of a lasting behavioral change. Financial media frequently described the company as a pandemic-era success story. The brand became closely associated with the transformation of home exercise. Institutional investors increased their exposure to the company's stock. Growth-focused funds viewed Peloton as a platform business rather than a hardware manufacturer. This distinction significantly influenced valuation expectations. Platform companies are typically valued on future recurring revenue potential. Hardware companies are usually valued on more conservative metrics. Peloton's subscription model encouraged investors to adopt the platform narrative. The company's leadership also emphasized this positioning. Public communications highlighted engagement levels and subscription retention. Recurring revenue metrics were presented as indicators of long-term stability. At its peak, Peloton's market value exceeded $40 billion. This valuation placed the company among the most prominent consumer fitness brands. The high valuation also created pressure to sustain rapid growth. Financial markets expected continued expansion in both users and revenue. Management decisions increasingly reflected these expectations. Production expansion and marketing investments aligned with the growth narrative. However, market valuations are highly sensitive to changing expectations. If growth slows, valuation models adjust quickly. Peloton's future would depend on whether pandemic demand represented a permanent shift. As global conditions evolved, that assumption would soon face a significant test. By late 2021, the conditions that had fueled Peloton's rapid growth began to change. Vaccination programs expanded across major economies. Governments gradually lifted pandemic restrictions. Gyms and fitness studios began reopening to the public. Consumers regained access to outdoor activities and public exercise facilities. Daily routines started shifting back toward pre-pandemic patterns. This change altered the demand environment for home fitness equipment. During lockdowns, home exercise had been one of the few available options. Once restrictions eased, consumers had more alternatives again. Some users returned to traditional gym memberships. Others preferred outdoor exercise and group fitness environments. As these choices returned, the urgency to purchase home equipment declined. Peloton began noticing slower order growth across its hardware products. New bike purchases no longer increased at the same pace as during lockdown periods. Customer acquisition costs also began rising. Advertising required greater spending to attract each new user. The market for connected bikes was becoming more saturated. Many consumers who wanted home equipment had already purchased it. The installed base of Peloton bikes remained large. However, the number of new hardware buyers began stabilizing. This shift had important financial implications. Peloton's expansion strategy had assumed continued demand growth. Manufacturing capacity had been increased significantly. Logistics networks had been expanded to handle high shipment volumes. Hiring had accelerated across the company's operations. These decisions created a larger fixed cost structure. When revenue growth slowed, those costs did not immediately decline. Inventory levels also began increasing as orders moderated. Products produced for anticipated demand were no longer moving as quickly. The company, therefore, entered a period of demand normalization. Demand had not disappeared, but it was no longer expanding at pandemic-era speed. For Peloton, the difference between explosive growth and stable demand became financially significant. The company now had to manage a cost structure built for a larger market than the one that actually existed. As demand growth slowed, Peloton began confronting the consequences of its expansion. Production capacity had been increased significantly during the pandemic surge. Manufacturing partners were already producing large volumes of equipment. Component supply contracts required continued purchasing commitments. This meant production costs remained elevated even as orders declined. At the same time, inventory levels started accumulating inside Peloton's logistics network. Warehouses filled with bikes and treadmills that had been built for higher demand projections. The company now had more equipment than customers ready to purchase it. Excess inventory created both financial and operational pressure. Products stored in warehouses represent capital that cannot be easily recovered. Peloton also continued paying for storage, transportation, and distribution infrastructure. These expenses reduced profitability across the business. Logistics costs had already increased during the pandemic due to global shipping disruptions. Container shipping prices and freight expenses rose sharply across many industries. Peloton had committed to large-scale distribution operations during this period. When demand slowed, those logistics systems became underutilized but still expensive. Operating expenses therefore remained high while revenue growth slowed. The company also faced challenges managing its workforce expansion. Thousands of employees had been hired during the growth surge. Labor costs therefore increased across manufacturing, support, and corporate operations. Reducing these costs required difficult decisions. Meanwhile, financial markets began reassessing Peloton's growth trajectory. Investors realized that pandemic demand might not represent a permanent shift. Valuation models began adjusting to slower growth assumptions. This shift in investor expectations affected Peloton's stock performance. The company's business model had not fundamentally changed. Connected fitness remained a viable concept. However, the scale of infrastructure built during the pandemic was now misaligned with demand. Excess capacity became the central financial problem. Factories, warehouses, and staffing levels had been designed for a larger market. When that market did not materialize, the cost structure became difficult to sustain. Peloton now needed to reduce expenses while maintaining its subscription platform. This transition would require major strategic adjustments across the company. As financial pressure increased, Peloton began implementing corrective measures. Management recognized that the company's cost structure had expanded too rapidly. Production levels needed to be adjusted to match the new demand environment. The company started reducing manufacturing output across several facilities. Some production lines were paused as inventory levels remained elevated. Peloton also reassessed its long-term manufacturing strategy. Plans for large internal manufacturing expansions were reconsidered. The proposed Ohio manufacturing facility was eventually canceled. This decision reflected the realization that demand projections had been overly optimistic. Operational restructuring also became necessary across the organization. Peloton announced several rounds of workforce reductions. Thousands of employees were affected as the company attempted to lower operating costs. These layoffs targeted corporate roles, logistics operations, and support staff. Leadership changes also occurred during this period. In early 2022, Peloton's founder stepped down as chief executive officer. A new leadership team was introduced to guide the restructuring process. The new management focused on stabilizing the company's financial position. Cost reductions became a central priority. Peloton also began exploring partnerships with external manufacturers. This approach allowed the company to reduce its fixed production commitments. Outsourcing manufacturing could provide more flexibility during demand fluctuations. The company also expanded digital subscription offerings. Standalone digital fitness subscriptions were promoted to users without Peloton hardware. This strategy attempted to broaden the company's addressable market. Peloton also experimented with selling products through third-party retail channels. Previously, the company had relied heavily on its direct-to-consumer sales model. Retail partnerships allowed Peloton to reach new customer segments. However, these changes required time to influence financial performance. Investor confidence remained uncertain during the restructuring period. The company's challenge was to reduce costs without damaging its brand and user engagement. Balancing operational discipline with long-term platform growth became the central strategic task. As Peloton attempted to restructure its operations, financial markets reacted quickly. Investors began revising their expectations for the company's future growth. During the pandemic surge, Peloton had been valued as a high-growth platform company. That assumption depended on continued rapid expansion of its user base. When demand began stabilizing, valuation models changed. Growth forecasts were reduced across many analyst reports. Lower projected growth rates directly affected Peloton's market valuation. The company's share price began declining from its pandemic peak. Each earnings report reinforced the new market perception. Revenue growth slowed compared with earlier pandemic quarters. Inventory levels remained elevated. Operating losses increased as restructuring expenses accumulated. Financial markets responded by resetting the company's valuation. The share price continued falling throughout 2022. Investors became more cautious about businesses that expanded aggressively during the pandemic. Peloton was not the only company facing this adjustment. Several industries that benefited from lockdown demand experienced similar corrections. However, Peloton's high-profile valuation amplified the market reaction. At its peak, the company had been valued at more than $40 billion. Within a relatively short period, that valuation declined dramatically. The market capitalization fell by tens of billions of dollars. For investors, the shift represented a reassessment of the company's long-term growth potential. Peloton still possessed a large subscriber base. Its digital fitness platform remained active and widely used. However, the market now valued the company more conservatively. Hardware demand was no longer expected to grow at pandemic-era rates. Subscription revenue remained important but was not sufficient to justify earlier valuations. The financial narrative surrounding the company had changed. Peloton was no longer viewed as a rapidly expanding technology platform. Instead, it was evaluated as a fitness company undergoing operational correction. This shift in investor perception marked the final stage of the market value collapse. The Peloton case illustrates a common challenge in corporate strategy. Companies must distinguish between temporary demand shocks and structural market growth. During the pandemic, demand for home fitness equipment increased dramatically. For Peloton, the surge appeared to confirm the long-term potential of connected fitness. Management decisions were therefore made based on expectations of continued expansion. Production capacity was increased, hiring accelerated, marketing investment expanded. These actions were rational if demand growth proved permanent. However, the surge had been created by extraordinary global conditions. Lockdowns temporarily restricted alternative exercise options. When those restrictions ended, consumer behavior began normalizing. Some customers returned to gyms and outdoor activities. The total market for home fitness equipment therefore stabilized. Peloton's core product remained viable. Connected fitness still attracted millions of users. But the scale of infrastructure built during the surge exceeded the long-term market size. Factories, logistics systems, and staffing levels had been designed for higher demand. When demand normalized, those resources became excess capacity. Excess capacity increases operating costs without generating additional revenue. Companies must then reduce expenses or restructure operations. These adjustments can take several years to complete. Financial markets often react before the restructuring process finishes. In Peloton's case, valuation reset rapidly as investors reassessed growth assumptions. The company's collapse in market value did not reflect the failure of connected fitness. It reflected expansion built on temporary demand treated as structural growth. The broader lesson extends beyond one company. Demand shocks can distort business planning across entire industries. When extraordinary conditions create temporary demand surges, companies must evaluate whether those changes will persist. If temporary demand is treated as permanent growth, expansion decisions can create long-term financial risk. Peloton's experience illustrates how quickly growth narratives can reverse when market conditions normalize.